It may be a great idea for citizens to own a large share of their hydro company, but what does this influence mean for investors? If you're in Ontario and you want to feel at least a little bit better about your hydro bill, you can pick up some Hydro One stock. You'll get utility-like dividends and low uncertainty, which is a nice defensive bet these days, but we don't see any claim to competitive advantages for Hydro One shareholders. Sector strategist Andrew Bischoff says that typically service territory monopolies and efficient scale advantages are the primary sources of an economic moat for regulated utilities. The hydro company is granted exclusive access to a market, but in Hydro One's case, the largest shareholder is the province of Ontario, which means the influence of politics doesn't exactly serve as a competitive edge. Bischoff says he doesn't have confidence that the province won't pass legislation at the expense of shareholders in the future, and says Hydro One's key risk to future earnings is political uncertainty. In contrast to its political environment, however, we see the regulatory environment as constructive and stable, which contributes to a low uncertainty rating overall. With Hydro One's steady cash flow from underlying businesses and management that continues to execute on all fronts, we continue to expect that it will be able to achieve the high end of management's 5 to 7% annual earnings growth target. And that high growth target comes from expectations from Hydro One to invest more than $11 billion into its business from 2024 to 2027 without the need for external capital. Now that's not something every utility can do. For Morningstar, I'm Andrew Willis.